Between 2018 and 2020, America supposedly went to war with China. Tariffs, trade war headlines, politicians promising to bring jobs home. But while the cameras were rolling, Wall Street quietly moved $1.4 trillion into Chinese markets, not before the trade war, during it. And once you understand why, you'll realize this has happened every single time a global reserve currency has collapsed.
From 2018 to 2020, the economic dispute with China was a major topic in the news. New tariffs were placed on hundreds of billions of dollars in goods. Leaders from both political parties adopted a firm stance on the issue. The prevailing message was that the U.S. was addressing its economic relationship with Beijing. But in those exact same years, BlackRock, Morgan, Goldman Sachs, and the largest financial institutions in the world moved $1.4 trillion into China. Not $105 billion, $1.4 trillion, and the peak year for this activity. 2020, right at the height of the economic tensions. This wasn't a coincidence, it wasn't poor timing, and the financial world wasn't caught by surprise by the political climate. This was a highly predictable financial development, because what we are seeing follows a pattern that has repeated for over 300 years, the four-stage cycle affecting every reserve currency. The global financial system is not random or chaotic. It operates on a four-stage cycle that has preceded the decline of every major reserve currency in history. Stage 1. Centralized money creation. A centralized system for money creation is established, typically through a central bank. Stage 2. Debt-financed expansion. This system is used to finance significant government growth and national expansion through debt. The economy appears to flourish. The nation's influence grows. A widespread belief emerges that the system is stable and secure. Stage 3. Growing imbalances. Debt levels rise significantly. The currency's purchasing power begins to weaken. The system faces increasing pressures and signs of instability appear. Stage 4. Capital repositioning. And this is the part that often goes unnoticed by the public. The same major institutions at the center of the system begin to move their capital into the next rising economic power before the full extent of the downturn is widely recognized. The general population is often left with a currency that has lost significant value. This pattern has repeated throughout history.
Britain, the original blueprint. In the late 1600s, Britain faced major financial and geopolitical challenges. A financier named William Paterson introduced a bold idea: the creation of the Bank of England. The structure was straightforward. The bank would provide funding to the government in exchange for interest. The government would ensure repayment through future revenues. The innovation was transformative. Government obligations became a foundation of the monetary system, and the bank's shareholders earned returns tied to the nation's circulating money. Within 4 years, Britain's national debt expanded significantly. By 1815, following the financing of the Napoleonic Wars, it reached £885 million. The lenders gained more than financial returns. They became deeply integrated into the structure of the state. Britain developed the world's largest navy, expanded its global presence, and the British pound emerged as the world's leading reserve currency. By the mid-1800s, shifts began to emerge. Industrial leadership evolved. Public obligations increased. Global commitments required new approaches. Quietly, British capital expanded into the United States. Railroads, steel, industry. By the time Britain left the gold standard in 1931, the financial center of gravity had already moved to New York. A transition completed. After World War I, Germany was assigned reparations totaling 132 billion gold marks, prompting the Weimar government to choose monetary expansion over higher taxation. The Reichsbank converted government obligations into currency at scale. And during the Ruhr occupation in 1923, workers were paid with newly issued money, leading to rapid price adjustments. By November of that year, $1 equaled 4.2 trillion marks. Later records indicate the central bank focused on acquiring foreign assets despite shifting price levels, a strategy international observers described as intentional. Domestic obligations were effectively reset, and Germany subsequently adopted an American-led financial framework through the Dawes Plan, allowing international capital to enter, restructure, and move on. 2 decades later, in 1944, the Bretton Woods system established the US dollar as a global reserve currency, backed by gold at $35 per ounce. The system remained stable for many years, but as US spending expanded globally and domestically, the supply of dollars eventually exceeded gold reserves. In response to growing redemption requests, The United States ended gold convertibility on August 15, 1971, transitioning the dollar fully to a fiat system, after which its value relative to gold adjusted over time.
On July 6, 2018, the United States announced new tariffs on China. 1 month earlier, MSCI began including Chinese shares in its global indices. That single adjustment prompted large-scale portfolio reallocations, directing capital from pension funds, endowments, and sovereign wealth funds into Chinese markets. By 2020, China represented 43% of the MSCI Emerging Markets Index. This marked a major shift in global capital allocation. Global financial institutions expanded their presence. BlackRock grew operations in China. Morgan obtained majority ownership. Goldman Sachs increased market exposure. The timing reflected a broader transition. A fourth phase, U.S. national debt, approximately $36 trillion. Debt to GDP ratio, around 98%. Federal Reserve balance sheet, over $7 trillion. Stage 1, the Federal Reserve established in 1913. Stage 2, long-term debt integration into the financial system. Stage 3, gradual currency adjustment. Stage 4, capital reallocation toward China. This is the current position.
This isn't a prediction. It's pattern recognition. The same framework that guided British capital toward America. The same framework that directed American capital into Weimar Germany. The same framework that reshaped the Bretton Woods system. That framework is now directing capital toward China. While public discussions focus on trade policy, while media attention centers on presentation, while broader audiences follow the headlines. To understand how the fourth phase unfolds, how the system was constructed, and what developments may follow, subscribe. This time, you're observing the pattern as it forms, not after it's complete.